A disturbing video was recently posted in which it was predicted that China's entire economy would collapse in the coming days. Why do we need to know about this? Well, China is one of the wealthiest countries and is vying to surpass the US dollar as the world's reserve currency. They manufacture 20% of the items we use on a daily basis and are on the verge of a complete financial meltdown, which would, of course, affect the rest of the world. Let's take a look at this video to see just how bad the situation is. China has been experiencing what many consider to be a real estate bubble in recent years. As citizens tend to prefer to invest their money in real estate as a security net, the real estate market grew by double digits year after year. Furthermore, the urbanization of most of rural China, combined with social pressures to own a home, led to a massive relocation to cities that offered better opportunities and higher potential earnings, driving up demand even further. In fact, the country was constructing 5 times as much as America and Europe combined, and supply was still so scarce that some cities would use a lottery system to decide who would get to buy a home, with odds as low as 1 in 60. As a result, the property market accounts for 70% of the country's wealth, which is more than twice as high as it is in the United States. However, there was another issue. People believed that the housing market was such a great investment that they would buy anything they could. Because even if they didn't live there and kept it vacant, they could always sell it for a profit at some point. At the time, property values were increasing so quickly that developers were pre-selling units in which the buyer would start making payments on a property that didn't even exist yet, with the presumption that it would be cheaper to buy today than it would be later, because property values would continue to rise. It also didn't matter how much it cost. Home buyers could spend up to 23 times their yearly income to purchase a home, with mortgage accounting for more than half their gross take-home pay. They funded and took out loans from family and friends just to be able to say they own a home. This resulted in a 22% vacancy rate across China as home buyers purchased second properties for investment just outside the city limits without restrictions, just as the government stepped in to buy the surplus inventory in order to keep the market secure. Furthermore, the increased building demand meant that there was less supervision in terms of construction quality, which led to significant construction problems as developers cut costs to save money and maximize profits. But there was an even bigger issue. These pre-sale units were not completed. It is alleged that some of the biggest property developers were taking pre-sale money, diverting it as down payments into new projects in order to garner even more pre-sale deposits, and then using new funds to gradually complete the construction of previous projects. While bank loans and bonds typically have an annual interest rate of at least 5%, capital raised through pre-sales is completely interest-free. The reality today is a city of shattered dreams and incomplete housing projects owned by 8 struggling property developers who lack the funds to proceed while construction has been halted. However, this is just the tip of the iceberg. As more projects fall behind schedule or are abandoned completely due to a lack of funding, buyers have staged a mortgage boycott in which all homeowners with outstanding mortgage loans will not make payments unless construction restarts before October 20th. Despite the fact that it all began with the property giant Evergrande being in debt for $300 billion, within 4 weeks, more than 320 developments in about 100 cities were facing mass protests, ravaging markets and forcing authorities to corral banks and developers to quell the unrest. Although the damage may be irreversible, home sales and property investments have been on the decline since February 2021. At the same time, the credit market expanded at an alarming rate as developers borrowed more and more to stay afloat. The US Federal Reserve even went on record saying that if China's real estate sector deteriorated dramatically, it could spread to the US. So what is China doing about it, and why does the situation appear to be declining from here? China, on the other hand, issued a statement stating that they have tightened legislation by monitoring and controlling customer funds and making timely delivery of new units. However, when 96% of the Chinese population is exposed to the real estate market and 13 million units have already been stalled in the last year alone, the effects will inevitably spill over into other industries, including banks. Protests broke outside the People's Bank of China, where customer deposits are held and have been frozen since April, when banking regulators announced an investigation into allegations of unauthorized financial activity. The authorities claim that the problem was caused by a bank invasion by criminal gangs dating back to 2011, was viewed with skepticism on Chinese social media, where the event was being closely followed. However, the China Bank and Insurance Commission claims that the banks in question were tricking customers with high-interest promises before unlawfully transferring those funds to privately owned criminal organizations. Over 400,000 customers in China have been victimized by similar bank activities, and it has been reported that 4,000 smaller lenders hold a quarter of the industry's total assets, which often have ambiguous ownership and governance structures and are more susceptible to fraud and the sharp economic slowdown. To make matters worse, even though those bank deposits are insured up to $75,000, people could lose everything if the bank is involved in non-compliant transactions. And China's greatest risk is that its people lose faith in the entire financial system. Another issue for banks is that almost all of them lend money to real estate developers who have been taking the funds needed to complete housing projects out of the country. For example, they could take out an $80 million loan, spend $10 million on a new property to collect even more pre-sale deposits, and then transfer the funds overseas, leaving the bank and the people on the hook for the unpaid amount. The Chinese government has agreed to reimburse their customers the equivalent of about $15,000, but this may not be enough to restore their customers' confidence in the banking system, leading to the widespread belief that everyone is concerned about, a bank run. China has done an excellent job of postponing the inevitable by reimbursing some accounts, facilitating overseas transactions, and possibly bailing out bankrupt developers by lending even more money. The solution to overextend properties is to simply lend more money to compensate. This new fund is expected to raise up to 300 billion yuan, which may be enough to restore market confidence while waiting for the economy to recover. As part of the government's efforts to increase rental housing, this fund would finance the purchase of unfinished home projects, complete their construction, and then rent them out to individuals. It's easy to believe that this is all about the Chinese market and that it has no bearing on you. Not true. Over the last decade, the United States has significantly increased its investments in China, which includes both large institutions and ordinary normal investors. Of course, it's worth noting that while we have over $118 billion invested in China, it's still a small amount of money in terms of the size of the US portfolio. However, Chinese companies have a lot of exposure to the US market, and when they need money, it makes sense that they will sell those assets to raise capital, resulting in a much more volatile stock market. The real impact for everyone in the US, however, is not a change in policy or a decline in the stock market, but rather investor impression that things could get a lot worse before they get better. China has made it abundantly apparent that their strategy is to protect the market at all costs while avoiding strict oversight. China will fall short of meeting its annual economic growth target of 5.5%, and we are quickly realizing that the days of China's meteoric economic rise are over. Expect the Chinese economy to be something to keep an eye on. That's all we have for today. If you'd enjoyed the video, why don't you give us a like and subscribe to our finance channel? Don't forget to hit the bell button below to get notifications on when we'd post next. Thank you for staying till the end of the video and hope you enjoyed. See you next time.